Hey guys, welcome back to the channel. In the first part of the Heikin Ashi video, we have covered all the basic things like the calculation, principles, differences and interpretations of Heikin Ashi charts and candles. So do watch that video first if you haven't already so that you will understand how to use the Heikin Ashi charts in the best possible manner. In this video, however, we will go deeper into the application side of things. We will learn a few ways to use Heikin Ashi charts, or we could say these are a few strategies that you can implement while using this chart. Then we will also briefly talk about the advantages and limitations when it comes to trading with Heikin Ashi charting technique. So make sure to watch this video till the end, and if you are benefiting from these video tutorials, then make sure you like this video, comment your opinions or suggestions, and share this video to your family and friends. Also consider subscribing to the channel because it's free, and enable the bell notification so that you won't miss out on any upcoming video courses. So without wasting any time, let's get started. When discussing the application side of Heikin Ashi charts, there are four main ways or strategies in which I personally like to use Heikin Ashi indicator for trading. The first method involves using Heikin Ashi charts to find market turning points or reversal points and then take reversal trades from there. Now the second method is to ride the market trend using Heikin Ashi candles and letting my profits accumulate over time. And the third way is all about timing the market for my long-term investments or positional trades. And the final method is to find and trade chart patterns like triangles, wedges, etc. using Heikin Ashi charts. Now, let's take a look at each of these strategies in greater detail. We will begin by finding market turning points using Heikin Ashi charts. So, identifying market turning points or reversals with Heikin Ashi charts involves two steps. The main idea is to find shifts in the market sentiment. Now, how will you find such a shift in the market sentiment? So, if you have watched the first video part, then you might have already guessed that we need to first find dojis or spinning tops with long upper and lower wicks on a Heikin Ashi chart. This step helps us to locate an area or zone for us to focus on. But it is important to note that dojis and spinning tops can highlight zones of either possible reversal or continuation where we can look for potential trading opportunities. In this particular strategy, we are only interested in reversal setups, or in other words, we are not looking for a trend pause and continuation. So once we have identified a suitable zone, in the next step, we switch back to the standard candlestick chart and look for reversal candlestick patterns. So these could be pin bars, morning or evening stars, abandoned baby patterns, etc. depending on the direction of trade that you are looking for. So take a look at this chart. I have circled all the candlestick patterns in the Heikin Ashi doji zones, which are in turn represented by rectangles. And as you can see, there was an evening star pattern at first, which is a 3 candlestick bearish reversal pattern. You can also observe a morning star candlestick pattern here, which is numbered 2. Now it is a bullish 3 candlestick reversal pattern. Now after the bullish swing that filled the earlier price gap and taking resistance from that level, the Heikin Ashi doji zone coincides with a 3 black rose pattern. This bearish candlestick pattern led to another downswing, which ended with a not so perfect double bottom pattern structure. In the next two trading zones, we can find 2 Morningstar patterns, but this time it has helped to push the bullish trend even further. Now this might look very cool and easy, but this trading approach is not perfect. Just take a look at the Morningstar candlestick pattern at the chart's bottom. The 2 bars before it formed a dark cloud cover pattern, which is a bearish reversal pattern. So if you would have taken that signal and gone short, it would have definitely resulted in a losing trade. But the general idea is to quickly identify areas of interest for further candlestick analysis. Now you can always make use of price action levels like support resistances, supply and demand zones, pivot levels, or even dynamic levels like trend lines or indicators like moving averages from which adequate buying or selling pressure could come in, thereby improving the probability of a winning trade. For example, a Morningstar pattern from a previous support level could result in a good long trade, and similarly, a shooting star pattern rejection from a previous resistance level can be a great signal for taking up a short reversal position. Now you can even use moving averages or a combination of 2 or more moving averages in association with Heikin Ashi charts. So it could just be a 20 moving average or maybe even 10, 20 and 50 moving averages. but the logic of the strategy will remain the same. You just have to find dojis or spinning tops in Heikin Ashi charts, then go back to the candlestick charts to find any reversal patterns. But in addition to that, we need to observe if the price takes a support at the 20 moving average level if you are looking for a long trade, or if the moving average acts as a resistance if you are searching for short trading setups. Then you could simply ride the price move by switching back to the Heikin Ashi chart and exit either when the Heikin Ashi chart forms a doji or a spinning top, or you can even consider exiting your position if the price breaks beyond the moving average level. And if you are planning to use two moving averages like 10 or 20 moving average, then in addition to all these factors, we will also check for a crossover between the two moving averages. So these are some of the basic setups that you can think of. But if you ask me personally, I like to make use of support and resistance levels along with rejection pin bar candles in traditional candlestick charts in association with Heikin Ashi charts for a higher probability trade setup. I even make use of CPR and pivot levels along with rejection pin bars for my reversal trades. Now let's discuss on how to ride the market trend, thereby letting your profits accumulate with the help of Heikin Ashi analysis. So here's a question for self-analysis. Are you one of those traders who have problem with looking at your charts for so long, or are you someone who cuts your positions prematurely, thereby not letting your profits accumulate, but regret losing the big price move that you could have captured if you have not exited too early? Now, these are some of the biggest issues that most traders face. But what if I tell you that by using Heikin Ashi charts, you could solve these problems to some extent? Now let's take a look at a very simple method of taking profits with Heikin Ashi charts. This idea is very basic and easy to implement. So the idea is that whenever a Heikin Ashi candlestick goes against our trade, we will exit our position. So if you are in a long trade, exit when you see a bearish Heikin Ashi candlestick if you are very conservative. This could even be a bearish small bodied candle. But if you want to remain in the trade for longer, or you are willing to take a tad bit of risk in the hope that the price will continue to trend, then consider exiting only when a strong bearish candle appears. But it is better to be cautious when an indecision candle or a bearish candle first appears, so that you can get ready with your exit order and can act fast in case of any opposite scenario. On the contrary, if you are in a short trade and if you are very conservative or risk intolerant, then exit when a bullish Heikin Ashi candlestick forms. But if you have more risk appetite, then be cautious if a candle formed is an indecision candle or a weak bullish candle, because there is still a chance for the current trend to resume. You will only exit when a strong bullish candle appears. Obviously, this waiting could reduce your profit at times, but the scope of riding a big trend once in a while can compensate for all these small losses. But as I have mentioned, it is up to you to decide based on what your risk appetite is. So if you are a beginner, I will ask you to stick with the first basic method of exiting at the first sign of a position rather than waiting for a continuation. You can stick with this simple method as long as you gain confidence, and once you learn to identify the underlying price action, you can wait out on few occasions where the trend can really play out, providing with enormous returns. And also keep in mind that most of these Heikin Ashi strategies work well in longer time frames. So if you are a swing or positional trader or even an intraday trader who trades on higher time frames, that is anything above 15 minutes, then these methods can work very nicely for you. But if you are a scalper or a very short-term trader, then it is better you exercise caution or maybe avoid Heikin Ashi altogether, because the averaging out or smoothing effect can badly affect your responsiveness in the market, meaning that you can struggle with fast entries and exits. Now in this chart, I have marked the exit points for both long and short trades using a straightforward tactic. Even though these exit points are not perfect, they are more than enough for a beginner trader to make some profits when coupled with a reasonable stop loss and a good reward to risk ratio. Another way to improve your odds is to make use of areas of values like supports and resistances to take entries. That is, you will take a short entry only from a resistance level and you will enter long trades only from support levels. This will help you to filter out some of the bad trades, leaving you with some good setups to trade on, and also help you to set a proper stop loss with respect to the area of value under consideration. But what's more interesting is that if you had applied the same exit method using a standard candlestick chart, you would have exited with much smaller profits. So with traditional candlesticks, it is very common to feel anxious watching the market move against you. This anxiety or fear might push you to exit earlier than you should. So by simply switching to a Heikin Ashi chart to monitor your trade, you will be able to remain in the trade longer and ride potential trends and accumulate larger profits. Now another point to note is to keep a trailing stop loss, which could be a chandelier stop or just a simple moving average depending on your trading time frame, so that you can ride the trend as long as it lasts without prematurely cutting your positions during a minor pullback. This is a more advanced technique and requires more control over your emotions and a good understanding about the real-time price action in play. So if you are a beginner, then stick with the basic rule. Now let's talk about the third method, which is timing our long-term investments using Heikin Ashi charts. Now you might be really confused because generally for long-term investments, exact timing is not critical when comparing to intraday or even swing trades. This is because for long-term investments, you are more likely to have a bias towards fundamental analysis, and it is one of the main reasons why many of you don't even invest. And even if you invest, you will not even use a strict technical stop loss to protect your capital if things go haywire. But the Heikin Ashi charts can help you with your investments as it highlights the trend changes, which can be used for timing your long-term positions. It saves you time and effort from over-analyzing the technicals and crunching over the fundamental data. So before we get to the idea, let's look at a scenario. This chart shows the market sell-off in March 2020, triggered by the coronavirus pandemic and other global concerns. Now this is a weekly chart of Nifty. You could take any other major stock during the crash and most of them would have reacted similarly. Now almost all stocks were available for purchase at a discount. Let's say you think that the market has overreacted and you are still bullish about the future. You would like to take this golden opportunity to accumulate a long-term position in Nifty or in any other stock. But then you have to remember one of the golden rules in the market. It is never to catch a falling knife. You should hope for at least some bullishness before you enter the market. Now what should we do? Now you could just take a look at the Heikin Ashi version of the same Nifty chart, and you will clearly see a shift in the market sentiment as represented by a doji candle, which is followed by a bullish candle. Now you can consider accumulating your positions from this point onwards. Further, at each point when the Heikin Ashi candlestick turns green after a short pullback, you could increase your market positions. This gives you a system to increase your investment position each time you detect bullishness in the market. Now this is one example. The system is so simple that you don't really need to do extensive fundamental research. But that simplicity could sometimes be a problem too, because doji and spinning top candles may not always indicate a reversal. It could just be a consolidation. So the reversal might not happen always and you could end up with a negative portfolio. But you can always improve your odds if you bring in additional confirmations. It could be price action, 52-week data, technical analysis, or even fundamental analysis on the stock could yield much better outcomes. So keep in mind that the general idea is to invest on pullbacks if you are aiming for very long-term investments or positional trades. This will also help to average out your positions, and you could also make use of indicators like 200 period moving averages to analyze the overall market sentiment before making allocations also. Now the last method is to trade chart patterns using Heikin Ashi charts or candles. You could easily find a lot of chart patterns ranging from double tops and double bottoms to triangles to wedges, channels, etc. But I like to use Heikin Ashi charts to trade triangles and wedges and sometimes even price channels. So if you want to learn more about chart patterns, I have already made a 3-hour long video on this topic. You can refer to that video to know more. Now let's talk about triangles first. Now there are 3 types of Heikin Ashi triangles: ascending, descending and symmetrical triangles. So if the price breaks above the upper boundary of a symmetrical triangle or an ascending triangle, then it is very likely that the uptrend will persist. You could look for long trades. Entries, stop loss and targets can be learned from the chart patterns video. Now, I would recommend you switch back to the traditional candlestick chart to take the trade entry, because you will have more flexibility in deciding whether you want to enter during the breakout or do you want to hold on a bit and wait for a pullback or retest to happen so as to get a much better entry price. On the contrary, if the candle drop below or break below the bottom trend line on the descending triangle or a symmetrical triangle, then most likely the bearish trend will continue, and you could look for short trades and keep appropriate entries, stop loss and targets. Now also keep in mind that breakouts usually require additional confirmations so that you don't get trapped in a fake out. So make sure to check for higher than average volume indication and check momentum indicators like RSI or stochastic to ensure a real breakout before taking a trade entry. Now, another point worth noting is that in order to trade the trend with this Heikin Ashi technique, it is advisable to use a trailing stop loss like a moving average or Chandler stop so that you could stay in the trend to profit from it if the trend is very strong. Now, let's talk about wedges. And as you may know, there are two types of wedges, rising wedges and falling wedges. Wedges are also a little more like triangles. So a rising wedge requires a trader to wait until a candlestick breaks below the pattern's bottom support line. And once that break happens, you could take a short trade because rising wedge is considered as a bearish breakout pattern. You could set your stop loss and targets appropriately. On the contrary, if you have a falling wedge, then you should wait for the price to break out above the upper trendline resistance, and there are high chances that the downtrend will reverse. So you could consider taking a long trade entry and set your stop loss and targets accordingly. Also make sure to trail your stop loss if you want to make most out of the trade in case a strong trending price action is in play. Now you can even trade channel patterns with Heikin Ashi. Channels are considered to be neutral or bilateral patterns, meaning that the price can either break out of the resistance trend line or break down below the support trend line. So whenever you are trading breakouts, you need confirmations. And these confirmations can come in form of a higher than average volume, which could in turn signal an increased amount of market participation, or breakout can also be confirmed using momentum indicators like RSI or stochastics. Sometimes using volume data and indicators in tandem can yield a much stronger signal. So in this case also, we should try to ride the price move using trailing stop losses, thereby maximizing our profits. Now at the end, let's discuss a few benefits and limitations of Heikin Ashi technique. So let's start with the benefits first. The most important point is accessibility. So Heikin Ashi is one of the most accessible indicators that do not require any installation, and it can be found on any trading platform, and it's free of cost. Second advantage is high chart readability. Heikin Ashi charts are very easy to interpret. The Heikin Ashi candlesticks can be easily analyzed than traditional candlestick charts, so it is easier to identify market trends and price movements. Also, you don't need to study all the traditional candlestick patterns by heart. Third and most important point is reliability. Heikin Ashi is a very reliable indicator, providing much accurate results. It uses historical data, which is quite dependable. Now, the fourth prime advantage is its ability to filter market noise. So it filters out market noise and reduces all those small corrections, making the signals more transparent. So this smoothing effect makes it easier for trend identification. So by filtering out noise, the Heikin Ashi charts can help traders to plan their entries and exit points more effectively. Now, another benefit is the ability to combine with other indicators. So just like candlestick charts, the Heikin Ashi charts can be combined with other technical indicators to give even stronger signals on the market movement. And the final advantage that I have noticed is time frame tolerance. So Heikin Ashi can be used on any time frame from hourly, daily, monthly, etc. So market participants with any trading style can adopt this technique. However, the bigger the time frame, the more reliable the signal is generated. Now let's talk about the limitations or drawbacks of Heikin Ashi technique. The first point is time gap or delay in signals. Since Heikin Ashi indicator uses historical data, it provides a delayed signal, or it is a lagging indicator. Even then, this delay cannot be an absolute weakness because it significantly reduces the number of false signals and can prevent false entries. Now the second downside is the lack of price gaps. Now most traders use price gaps to analyze price momentum, trigger their entries, or place their stop loss orders. Price gaps even function as supply and demand zones. Although Heikin Ashi lacks price gaps, you can counter such a limitation during trading session by switching between traditional candlesticks and Heikin Ashi. Another drawback is the unavailability of the complete price information. So Heikin Ashi data, as you may know, is averaged. Hence it does not show the actual open and close prices. So this may not work very well for very short-term traders or scalpers. So I would generally recommend using Heikin Ashi charts for swing trading, positional trading and long-term trading. This is because the larger the time frame you use, the more valid the market momentum detected. And if you use a time frame that is too small, then detecting momentum in the market will be much more difficult. Therefore, this chart is not very suitable, especially for traders using scalping techniques. Now, to wind things up, if we depend solely on Heikin Ashi chart, we might miss key price features like price gaps and candlestick patterns. This is why I recommend using Heikin Ashi chart to identify noteworthy price action before switching to standard candlestick chart for further analysis. For instance, when the market is in a clear trend, there is no need to overanalyze. But when the market starts to stall or consolidate, then it is time to assess if the market is merely taking a break or preparing for a reversal. So in a nutshell, the Heikin Ashi candlestick chart is a simple yet powerful tool that, if used in the right manner, can yield tremendous results in your trading. So keep learning, backtest what you have learned, practice it and apply it in your trades to see if it really works for you. I hope this video was useful to you. If it was, then please do like and share this video, subscribe to this channel and also enable the bell notification so that you will never miss out on any new video updates. I will meet you guys with another video. Till then, see you.